This is what actually happened when Western nations cut Russia from SWIFT in 2022, and why the claim that it destroyed the dollar forever doesn't match reality. What the sanctions actually triggered was the most significant restructuring of global financial architecture since Bretton Woods, though the outcome turned out far more complex than any headline suggested. Now, most people think SWIFT is a payment system, which creates a massive misconception about how any of this works. SWIFT, the Society for Worldwide Interbank Financial Telecommunication, simply transmits secure payment instructions between over 11,500 financial institutions across more than 200 countries. Founded on May 3, 1973, in Brussels by 239 banks from 15 countries, the system functions like a postal service for bank instructions, delivering the letter but never containing the cash itself. The actual money never flows through SWIFT at all. Daily message volume hit 47.6 million as of 2023, and before the sanctions landed, Russia operated the second highest number of SWIFT users after the United States, with approximately 300 Russian banks connected to the network. This connection looked like such a powerful weapon because we'd watched it work before. Iranian banks got cut off from SWIFT on March 17, 2012, which caused Iran to lose nearly half its oil export revenues almost immediately. Oil exports collapsed from 2.2 million barrels daily in 2011 to just 700,000 by May 2013, a drop that contributed significantly to bringing Iran to the nuclear negotiating table. Back in 2014, former Russian finance minister Alexei Kudrin ran the numbers and estimated that exclusion could shrink Russia's GDP by 5%, while then Prime Minister Dmitry Medvedev went further and called such action tantamount to a declaration of war. When the invasion of Ukraine happened in February 2022, the SWIFT weapon sat loaded and ready to fire. What most people don't realize is that the path to disconnection started 8 years earlier. Russia annexed Crimea in March 2014, and by August of that year, the UK government under David Cameron proposed blocking Russian SWIFT access entirely. SWIFT refused to comply, which prompted Russia to develop its own system for transfer of financial messages called SPFS and launch it in 2014. The decisive moment arrived on February 26, 2022, just 2 days after Russian forces invaded Ukraine. A coalition of the EU, US, UK, Canada, France, Germany, Italy, and Japan jointly announced they would remove selected Russian banks from SWIFT, and that word selected matters because this wasn't a total shutdown. When implementation began on March 12, 2022, 7 Russian banks got disconnected, including VTB Bank, which held 18.59 trillion rubles in assets as Russia's second largest institution, along with Promsvyazbank, Bank Odkrity, Sovcombank, Novikombank, Rossiya Bank, and Vinnyshikonombank. Here's what everyone missed at the time. Sberbank remained connected to SWIFT despite holding 37% of Russia's banking sector and serving 100 million customers, and the reason was simple. It processed most European gas payment transactions. Only on June 14, 2022, when the EU rolled out its 6th sanctions package, did Sberbank finally get disconnected, and even then, Gazprombank stayed online because of its heavy involvement in energy payments and remains connected as of 2025. The immediate impact looked like financial apocalypse. February 24, 2022 saw the Moscow Stock Exchange Index plunge 33 to 45%, wiping somewhere between $190 and $259 billion in market value off the books. Ruble exchange rates crashed from roughly 75 per dollar to a crisis peak between 120 and 134 by early March, which forced the Central Bank of Russia to implement an emergency interest rate hike of 1,050 basis points to 20% on February 28, the largest single increase in Russian monetary history. Every major institution predicted total economic collapse. IMF and World Bank forecasts called for GDP contractions between 8 and 11% for 2022, but here's what nobody expected. Russia's economy contracted just 2.1%. By June 2022, the ruble had recovered to 54.20 per dollar, its strongest level in 4 years, a reversal that shocked analysts across the board. Several factors explain how Russia survived what should have been financial devastation. Record energy revenues from high oil and gas prices generated a $316 billion trade surplus in 2022, providing a cushion nobody anticipated. Western nations froze roughly half of Russia's $630 billion in reserves, somewhere between $300 and $330 billion, but the remaining accessible reserves provided enough stabilization to avoid collapse. War economy spending doubled defense expenditure to 10.78 trillion rubles, about $100 billion, which accounted for 29.4% of the 2024 budget and kept money flowing through the system. Exports pivoted away from Europe toward China, India, Turkey, and the UAE, opening alternative trade channels that replaced blocked Western markets. Growth returned by 2023 at 3.6%, and estimates for 2024 suggest another 3 to 4% expansion. Inflation stayed elevated at 8.5%, and interest rates hit a record 21% by October 2024. But calling this financial devastation stretches the definition beyond recognition. And that's when the big question emerges: did any of this destroy the dollar? Looking at what actually happened to dollar dominance reveals a pattern that predates the sanctions by 2 decades. IMF data shows the dollar comprised 72% of global reserves in 2001, dropping to 65% by 2015, then 59% by 2020, and finally 57.8% by the fourth quarter of 2024, the lowest share since 1994. But here's the part that matters most. The Federal Reserve's 2025 analysis found no statistically significant acceleration in de-dollarization following the 2022 sanctions, and the report stated plainly that the dollar share remained basically unchanged since 2022, when it accounted for 58% of reserves, suggesting that US sanctions on Russia following the invasion of Ukraine have not led to fears of dollar weaponization, causing a notable reallocation of reserves out of dollars. The decline exists but unfolds gradually rather than dramatically, and it started long before Russia invaded Ukraine. Central banks diversified away from dollars but not into yuan, which holds only 2.18% of global reserves, and instead moved money into what economists call non-traditional currencies like Australian and Canadian dollars, Swedish krona, and South Korean won. Gold holdings in reserves climbed from under 10% in 2015 to 23% by 2024, though this largely reflects gold's 200% price appreciation rather than central banks buying massive new quantities. China moved most aggressively to reduce dollar exposure, cutting US Treasury holdings from a peak of $1.32 trillion in November 2013 down to just $757 billion by April 2025, a 42% reduction that represents the largest deliberate divestment from dollar assets by any major economy. The most significant financial shift didn't happen in global reserves, though. Russia and China essentially eliminated the dollar from their bilateral trade relationship in just 3 years. Before 2022, less than 2% of bilateral trade got conducted in yuan, but by February 2025, Russian Finance Minister Anton Siluanov declared that 99.1% of Russia-China trade now settled in rubles and yuan. Two of the world's largest economies removed the dollar from their relationship almost completely in the span of 36 months. Trade volumes exploded alongside this currency shift, growing from $140 billion in 2021 to $254.8 billion by 2024, while the yuan became Russia's primary foreign currency, with its share on the Moscow exchange reaching 42% in 2023 and exceeding the dollar for the first time. Yuan-denominated loans in Russia tripled to $46.1 billion, creating an entirely new financial ecosystem that operates without American currency. India followed a similar path and expanded rupee-ruble trade with Russia, pushing bilateral commerce from $13 billion before 2022 to $68 billion by 2024 and 2025. Around 96% of India-Russia trade now settles in national currencies, though this created an unexpected problem. Russia accumulated over $40 billion worth of rupees with limited use because India's currency isn't freely convertible and can't easily be spent elsewhere. So if the sanctions pushed Russia to build alternatives, the question becomes how successful those alternatives actually turned out to be. Russia's SPFS system grew substantially but faces limitations that prevent it from replacing SWIFT.
Created in 2014, SPFS connected only 400 institutions by 2018, and post-sanctions growth brought membership to 584 institutions across 25 countries by April 2025. The problem is that SPFS offers only about 50 message formats compared to SWIFT's over 100, cannot process transactions on weekends or outside limited hours, and requires
1.5 years or more for new banks to integrate. What really killed its expansion was the EU's 14th sanctions package in June 2024, which banned EU companies from using SPFS entirely, while US authorities issued aggressive warnings in November 2024, threatening any institution that joined the system. China's cross-border interbank payment system called CIPS represents a more serious development. Launched in October 2015, CIPS grew to 1,783 participants across 189 countries by May 2025, processing 175.49 trillion yuan, about $24.47 trillion, in 2024 alone, a 43% increase from the previous year. What's interesting is that CIPS maintains a partnership with SWIFT rather than competing directly, and many CIPS transactions still use SWIFT messaging underneath. Then there's the mBridge project, a cross-border central bank digital currency initiative involving China, Hong Kong, Thailand, UAE, and Saudi Arabia that reached minimum viable product stage in June 2024. The problem came in October 2024 when the Bank for International Settlements withdrew from the project entirely, handing control to participating central banks amid growing concerns about the system being used for sanctions circumvention. Alternatives are emerging, but here's why the dollar still dominates everything. The US Treasury market exceeds $28 trillion in marketable securities, creating the deepest and most liquid sovereign debt market that exists anywhere on the planet. EU jointly backed debt totals only around $700 billion by comparison, barely 2.5% of the Treasury market size. The dollar appears on one side of 88 to 89% of all foreign exchange transactions according to 2025 data, still accounts for approximately 49% of SWIFT payments, and backs 60% of international debt instruments. Economist Barry Eichengreen describes this as incumbency advantage, noting that once a currency dominates trade invoicing, reserve accumulation, and cross-border clearing, rivals struggle to displace it because the entire global infrastructure runs on that currency. The yuan remains not freely convertible, with strict capital controls limiting international adoption. The euro lacks a unified fiscal issuer behind it, and no other currency comes close to meeting the basic criteria for reserve status. History shows us that reserve currency transitions take generations, not years. The British pound's decline as reserve currency took somewhere between 30 and 70 years after the US economy surpassed Britain's, and even as late as 1945, sterling still held 81% of global reserves despite Britain's economic dominance ending decades earlier. Geopolitical consequences continue to unfold from the sanctions. BRICS expansion reflects this new reality, with the bloc now including 10 full members and 10 partner countries that collectively represent 43.9% of global GDP and 55.6% of world population. Internal divisions prevent unified action though, and at the October 2024 Kazan summit, Putin acknowledged that a BRICS currency remains premature, while no common payment system got formally launched despite years of discussion. Central banks globally started hedging by purchasing record amounts of gold, buying over 1,000 tons annually for 3 consecutive years through 2024. China's gold reserves reached 2,196 tons by May 2025, while India repatriated 100 tons of gold from the UK in 2024, specifically over concerns about potential asset freezes. The Trump administration added new complications to this situation. November 30th, 2024 brought threats of 100% tariffs on any country creating or backing a currency to replace the dollar, though Russia's Kremlin dismissed these concerns by pointing out that no actual BRICS currency discussions have occurred beyond theoretical talk. So here's what actually happened. The framing that SWIFT sanctions destroyed the dollar forever falls apart when you look at the evidence, because what occurred was accelerated fragmentation of the global financial system into parallel architectures rather than dollar replacement. CIPS operates alongside SWIFT now. Bilateral currency arrangements coexist with dollar-denominated trade, and gold accumulation happens simultaneously with treasury holdings, rather than replacing them. The sanctions demonstrated both the dollar's power and its limits in ways that surprised everyone. Russia's economy survived through adaptation, trade rerouting, and deepening partnership with China. But Russia's GDP remains smaller than Italy's, its financial system sits largely isolated from Western markets, and its dependence on China has grown asymmetrically in ways that limit Russian autonomy. For the dollar's long-term future, experts emphasize that the real threat comes from US fiscal policy rather than BRICS alternatives. Former Treasury and Federal Reserve economists concluded that any severe deterioration in the US financial and economic situation could threaten dollar status, meaning the dollar retains its position not through American virtue, but through the absence of viable alternatives and the immense costs of transitioning global financial infrastructure away from a system built over 80 years. The honest assessment looks like this. Gradual erosion continues, but dollar collapse remains nowhere in sight. A multipolar currency system may emerge over decades, but as of 2025, the dollar remains secure in the near and medium term, according to major financial institutions. The SWIFT sanctions didn't destroy the dollar. They revealed that the global financial system is fragmenting slowly, but replacing 8 decades of dollar infrastructure turns out far harder than any headline suggests.